Good afternoon, everyone. I really appreciate you giving me your time. I'm going to try to move as quickly as possible because I really do have a lot of information to provide you. Just with this quick disclaimer, I'm just going to cancel this out. All signals and trading opportunities are for educational and demonstration purposes only, that we are not licensed commodity trading advisors. Never miss more than 2% of your account on any given trade. Do your own due diligence, consult a financial advisor prior to make any trading decisions. And with that said, just a little bit about myself. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia, and I've been involved in the financial markets for over 20 years. I began trading futures and Forex about 10 years ago, and I've been involved in the optimization of software systems for the last 10 years via mathematical modeling. And what we do here at Right Line Trading is we look at every single individual trading instrument as a closed system, whose movement is defined by certain independent variables. The preceding trader talked about Bitcoin, which I think is really an interesting trading opportunity. Bitcoin is a closed system. If you want to be able to define the forces that are brought to bear on that trading instrument and then be able to predict its future direction, that's exactly what we do. We do mathematical modeling. And there's a big problem with current technical analysis. That is the tool that traders use to determine the future direction of price on any given financial instrument, and it's the reason why 95% of day traders fail. It's because their ability to predict where price is going to move out into the future on any given financial instrument is really so poor. And this will be unacceptable in any other type of endeavor, because let's say if we were talking about architecture or talking about medicine, if 95% of all the buildings that were erected fell down, or 95% of all the patients that were treated died, then what happens is that scientists go to work on it, and what they do is through really rigorous scientific analysis, they determine what components of the methodology don't work, and they would pull them out, and they would magnify the components of the methodology that were successful. But for some reason, it does not happen in day trading, and there are really very few, like, academic institutions that look upon it as a science. And so what happens is there's no evolutionary process that takes place. Day traders continue, and swing traders continue to use the same trading methodology, the same technical analysis that they used 20 years ago, and very little has failed. And one generation of day trader and swing trader passes down to the next generation at essentially the same core trading methodology that sent them into bankruptcy. So what we do here at Right Line is we don't accept any current dogma without mathematical verification. And if you do a Nexus Lexis search of the world literature, you're going to find that there's almost no rigorous scientific analysis done on what components of current technical analysis work and what components don't work. So we had to do our own analysis. What we came up with is interesting, and I'm going to show you those. Now, first of all, if you look at, you're going to see that traders that use an oscillator, that use MACD, use Fibonacci, or use classic Elliott wave, all lose money. Now, if you know that traders have been using oscillators for 25 years. They can trade oscillator divergence, they can trade MACD divergence, they get run over consistently. The problem with both of these indicators is they tell you where price has been, but they have no predictive value and tell you where price is going to go out into the future. Fibonacci was an 11th century mathematician who created Fibonacci transformations, which is a series of equations that he used to develop Fibonacci numbers. And those Fibonacci numbers in no way can possibly predict where the future direction of price is going to move on your financial instrument. These were developed 900 years before the stock market was invented, and they simply don't work. And I'm going to show you why they can't possibly have any predictive value in telling you where price is going to move. Now, at least Elliott, when he developed Elliott wave, created it for the market, but his classic 5-wave movement just doesn't have any practical applicability to day trading or swing trading. The independent variables that are important is analyzing the multi-time frame direction of trend. When the trend aligns on multiple time frames, and in our case 3, you have a the potential for a very favorable trade. When money is flowing in your direction, you always want to track the direction of institutional money. Now, we use correlative markets, and they're extremely accurate. Everybody always talks about how they can actually track money flow, but I'll show you how we do it and how accurate it is. Then we look at the multi-time frame analysis of order flow. An order flow simply tells you on the bid side ask of the dome, are there more buyers or there are more sellers? We track it on a multi-time frame basis, and we just create a moving average of the delta. And then we look at a multi-time frame analysis of momentum, and then we use market profile, a really advanced version of market profile. Now, this is our 3-line indicator, which is now 2 lines, and it assesses momentum and order flow on a multi-time frame basis. Now, it looks at the 2 higher time frames. It doesn't analyze any information from your trading chart. And if momentum is down on your 2 higher time frames, the upper line gives you a red. If momentum is up on your 2 higher time frames, you get a green. Now, the 2 higher time frames are built into the algorithm of the indicator. Like, excuse me, if you're trading a 3-minute, your 2 higher time frames are automatically assessed at 9 minutes and 27 minutes by default. If you want to change that, you can. Now, order flow. Now, if you're trading let's say a 377 tick, it looks at the next 2 higher fib numbers. Now, fibs do have symmetry. They're just not going to be able to predict where price is going to go on your go out into the future. And if you're trading a range, like a 5 range, it's going to look at an 8 range and a 13 range. Again, the 2 higher fibs. It's all built into the algorithm of this indicator. So what we look for is momentum to be aligned either to the downside or to the upside on our 2 higher time frames, and for order flow to be aligned to the upside or to the downside on our 2 higher time frames. And order flow is simply, again, looking at which is more prominent on the dome. Are there more buyers or are there more sellers? The difference between the buyers and sellers is called the market delta. We put the market delta into a 15-period proprietary moving average, and we create a moving average of the delta. And when the delta is heading down on our 2 higher time frames, that's when we get a red. So we look for the alignment of order flow and momentum. And the key is this indicator does not look at price on your trading chart. It only looks at the 2 higher time frames. So let's look what happens when the multi-time frame analysis of momentum aligns with the multi-time frame analysis of order flow. Now there's a lot of ways of assessing momentum. We do it using a modified Heikin-Ashi formula, and you can see the price is going to rise. And this indicator is not even looking at price on your trading chart. It's looking at momentum and order flow on your 2 higher time frames. Now it tells you 2 things. That one, once price breaks resistance, it's almost always going to rise. Whether this is a futures market, a Forex market, the stock market, or even Bitcoin or any of the cryptocurrencies, they're going to go long. If you try to counter trend trade the direction of any of these, you're going to get stopped out. Same thing here. I purposely took out the time frame and I purposely took out the instrument because that's irrelevant. You're trading any financial instrument. When order flow and momentum align to the upside on your 2 higher time frames, the price on your trading chart is going to rise. I want to hedge it with almost always going to rise, but it really is going to rise. Now, if you want to counter trend trade, which I don't recommend that you do, at least you have to wait till order flow and momentum reverse and align to the downside before you can try to call a top and counter trend trade. Now, what happens, and this is on the E-mini, what happens when order flow and momentum don't align? Since they're both independent variables and have an equal say in the future direction of price, when they don't align, the market is simply going to chop. And that's really what a chop market is. It's when the independent forces that come to bear on creating the future direction of price don't align. Price simply just chops around. When order flow and momentum finally align, price is going to take a drop. Now, we're not talking about getting an entry. All we're talking about right here is a bias, knowing which direction to trade. You can see there's lots of counter trend traders trying to counter trend the market. They're all in these green candles, and they're all going to get stopped out. Here's one more example: non-alignment, chop, alignment, price is going to rise. Now, this is one of the most powerful independent variables there are. Left to its own devices, every financial instrument wants to chop. The only thing that creates a trend is the application of money. Now, what we look for, and we almost only exclusively trade during these periods of time, and I want to try to get to a live chart to show you our 2 trades today, is that we wait for a multi-time frame alignment in trend. This tells you that the financial institutions are participating in the trade, and they're creating a 3 time frame alignment. It's the same thing. If you're looking at a 5 range, they're looking at the indicators looking at the 8 range and the 13 range. If you're trading a 3-minute, it's looking at the 9-minute and the 27-minute. It's only analyzing the trend on the 2 higher time frames, not on your trading chart. And what this pink background tells you is that the indicator is telling you on the 2 higher time frames, the 50 is sloping down, the 15 period is sloping down, the 15 has crossed the 50 to the downside, and price has dropped below the 50 and the 15. So price has broken support. So with that, now you can do this if you monitor 3 time frames, but you can get the power of that analysis with the indicator simply by looking at your trading chart. Now, once your background goes pink, you know that you have all support broken on the higher time frames. The 50 is sloping down, the 15 sloping down, and the 15's crossed the 50 on the higher time frame. Price on your trading chart is heading in one direction. It's heading down. And anyone who tries to counter trend trade again is going to get stopped out. I wait for this alignment before I take a trade. This gives you the lowest risk, highest reward trades that are available on stocks, futures, and Forex. Here's a long trade, and this is on the E-mini. Now, the size of this trade is really irrelevant. The only thing that matters is we have a multi-time frame alignment to the upside, and the only direction that you can trade is long. And anyone, again, trying to counter trend trade in these red candles using oscillator divergence, MACD divergence, trading off of Fibonacci resistance, trying to trade with Elliott wave, they're just all going to get stopped out. Now look what happens when this area is clear. The market is going to just move and chop. There's going to be no real well-defined direction. Now we're going to look at, I'm moving through kind of quickly, but I want to get through all the material so I can show you a live chart. Now let's look at the correlative markets. Now correlative markets really do the best job of tracking institutional money than any indicator that I have ever seen. Now order flow to an extent does track institutional money. When there's a multi-time frame assessment that tells you that there's more buyers than sellers or more sellers than buyers, that is tracking money flow. But this, I think, is a more precise assessment of money flow than even order flow. Now, when the E-mini, the NASDAQ, the Russell, and the Dow all fall, in this case, we're looking at the E-mini fall, or stocks fall, an individual stock falls, or an ETF falls, certain other instruments go up. We know that with at least a 70% correlation coefficient, that bonds and notes go up, certain currencies go up, precious metals go up, and all this is telling you that there's a rotation of institutional money from asset class to asset class. And that's all that takes place in the course of a day. I mean, if in any given day there's a fixed amount of money in all the financial markets, and all the institutional traders do is rotate their money from asset class to asset class. The use of correlative markets, we track that rotation from asset class to asset class. Now here's an example on bonds. Now there's 3 correlative markets in each line. And when these lines are green, green, and this indicator is not assessing the direction of price on bonds at all. It's assessing the direction of the correlative markets of bonds. It's assessing the direction of markets that correlate in the same direction and markets that correlate in the inverse direction. Looking for that sector rotation, that group that go up when bonds go up, and that group of financial instruments that go down when bonds go up. So when this is green, green, it's telling you that money is flowing into bonds. Green, green, money is flowing into bonds. When it's yellow, green, or yellow, yellow, there's no institutional sector rotation of money, and bonds just chop. So it not only tells you, it not only gives you a precise direction, but it also tells you when to step aside and when not to trade. Which is important. Now, getting a winner is equally as important as avoiding a loser. And actually, the correct methodology for day trading and swing trading is not looking to get every winner. It's looking to avoid every loser. That's trading with specificity. You know, it's a mathematical term, but it's really another reason why so many day traders fail. They look to grab all the winners they can when what they should be doing is looking to avoid every loser. Now, I showed you that move on the E-mini with the multi-time frame alignment of trend. Here's what was happening with the movement of money, and that the money was flowing into the E-mini. Now, when large money is flowing into a given market, it oftentimes causes a multi-time frame alignment and trend. You oftentimes are going to see order flow and momentum align too. So all these independent forces align to give you a terrific trading direction, and then the software is going to give you a trading entry. I'm just going to skip these so we can move. Now let's look at market profile. Now market profile is based on really, really solid math. That in a perfect world, the random distribution of any data set creates this bell-shaped curve. And the price at which most volume crosses is the median price. It's also the mean price and the mode price. And 66 and 2/3% of all volume at price, or one standard deviation, creates the fair value of your trading instrument. Now, price wants to desperately stay within that fair value area. And it doesn't make any difference what the financial instrument is. If these principles were not applicable across every trading instrument and every time frame, then they would not be, they wouldn't be worthwhile. These principles work on every financial market, whether it's a stock, future, forex, and even now the cryptocurrencies. Nothing escapes this. Now, when a price approaches the value area high, it's going to get pushed down. When it approaches the value area low, it's going to get pushed up. So price is going to want to stay in this zone. The point of control is where most volume is crossed at price. So the POC attracts price, the value area high and the value area low repel price. Now, there are also critical low volume nodes, which are price where nobody wants to trade the financial instrument. So they're just the opposite as the point of control. Now, trades off the point of control are terrific. It's a great area to look for to take trades off of. And avoiding these areas here, the confluence of low volume node in VAH, low volume node in VAL, value area low, are critical to trading. Because what they do is they create zones of rejection. Now, for different reasons, price has a lot of difficulty moving through them. Through the upside, you have the force in which price wants to stay within fair market value. You also have the fact that this low volume node is a price that traders just don't want to trade this financial instrument at. So when it moves to the upside, up into resistance, it's oftentimes going to get rejected to support and pushed back up towards the point of control. And here's just another example. I don't have any of the other indicators which track the other independent variables, but price comes up and hits, price comes up and hits. Eventually price gets rejected, breaks support, comes up to resistance, and then down you go. Now here's an example just using order flow. Once you break support here, the only direction you can trade this market is short to support, where you're out. Then once order flow goes green, you can trade long off support. Then when it goes red, you wait for it to break support, come back to support, which now becomes resistance, and trade it short. And now that you're sitting on support, you wait for order flow to turn again, in which case you would go long. If you don't obey these trading laws, there's a lot of traders in these moves that don't. Those are the traders that get run over. And those are the 95% of day traders and swing traders that lose their money. Now, what we've created, this is a slightly different kind of chart because this is our Sierra charts version. What we created is a point of control or commitment of traders within each candle. And you can see it's that yellow tick value right here. And now this is called the COT, and it is a really powerful tool to trade. Now you can see the background bias is green, so we know there's a multi-time frame alignment to the upside. And we know that the 50 and the 15 are green. The yellow line is the VWAP, or the volume weighted average price, which acts as another area of support and resistance. Now when price drifts back to support, you want to take a long trade on this candle when the commitment of traders is at the bottom. That gives you a tremendously high probability win, extremely low risk, and potentially high reward trade. It's just the opposite when you're taking a short trade. Now here the short isn't to support. This is the point of control. But the 50 is down, the 50 is down, the 15 is down, and the point of control or commitment of traders is at the top of the candle, and it's surrounded by intense selling, just like this area is surrounded by intense buying. And down you go. And you'll notice there's a double top here. That's another reason why this is a very advantageous short trade. That's a big trade. This is a 13 range candle. And here's another example. When you get a pullback to support, and this is the value area low. Now I said it's the point of control, but I mislabeled it. Point of control is here. You see that the commitment of traders or point of control of the candle is at the bottom, which is exactly where you want it on a long trade. Point of control is at the bottom. Point of control is towards the bottom, more towards the middle here. But what you can do is make an assessment. See, as you approach the VWAP, that's an area of resistance. Is it likely to break or hold? Well, if the commitment of traders is close to the bottom of the candle, it tells you that you're trading with enough power and authority to potentially break resistance, stay in the trade. And you continue to go up and up and up. And as the trade burns out, that's where the COT begins to rise to the top of the candle. Here's another trade. This is on the E-mini. POC's at the bottom, commitment of traders. It's trading right off of the support of this pivot and the 50. Background bias is cyan. That's a multi-time frame alignment to the upside that's not quite as powerful as the dark green, but you know the direction you must trade is long. No trades where this area is clear. You can see how price is just choppy here. As soon as we get an advantageous long entry, up we go. And that's based on this is all in our market profile. Now, I don't have order flow here. I don't have momentum. I don't have a lot of the other indicators that we use to assess market direction. I'm just kind of peeling it apart for you right now. Now, the cash metrics is this is the only software that utilizes this indicator, and it's really amazingly powerful. Now, I have 21 indices in 4 groups, but it's 16. And what it does is it looks at 16 market internals on the Dow, the NASDAQ, the S&P 500, and the Russell. So it's useful to trade futures and stocks. 6 of the internals are volume. Now, these are some of the internals it looks at. With the semiconductor index, S&P 500, these all go into your trader. We install that all for you. And essentially what we're looking at is we're looking at the ratio of up volume to down volume, the ratio of issues advancing versus issues declining, the ratio of issues on the uptick versus the downtick. Then we looked at certain specific ETFs, certain specific indexes to give us a real honed down view of what's going on in those 4 markets, the Dow, NASDAQ, Russell, and E-mini S&P 500. Now, you can see it says cash quant cash, and we call it the cash metric lines. The 6 tick metrics, the 8 tick metrics are in the upper line, and the 8 volume metrics are in the lower line. And for some reason, the tick metrics are faster than the volume metrics. And I don't know why that is, but it's just the way it turns out. This is the way you trade gaps, you trend trade, you trade market open, and you trade reversals. Now here is Facebook. You can see we have green background bias. Here's the cash metric. All 16 market internals are aligned to the upside. And Facebook is almost always going to rise. Now I have a fast chart. This is an 8 range. You can trade a 1 hour, you can trade a 2 hour. The higher the time frame you trade, the greater the potential profit, but the greater the risk. On an 8 range, on this particular chart, you made 40 cents on Facebook on a profit, on a risk of 10 cents. It's a 4-to-1 risk to reward. Here's Perigo, cash metrics, order flow momentum, background bias, all those independent variables I talked to you about are aligned to the upside, pull back to support. I haven't talked about the C-candle entry, but it's right here. 75 cents of profit on 10 cents of risk. On 1,000 shares, that's $750 on $100 of risk. Here's Tesla, 65 cents on 15 cents of risk. Now remember, these are fast charts. I like to trade fast charts. If you want to trade a 1 hour or a 2 hour, you can look for $1.50 or more on a move, but you're going to take a greater risk, a 65 cents on 15 cents of risk. Now this is a huge move on Netflix. This is from 8/21/17. Background bias tells you that the only direction you can trade is short. The cash metrics, all 16 market internals are to the downside. You're trading off a C-candle, off of a volume profile resistance to the downside. I only scaled it down to a 99 cents, but you could have taken the move all the way down to this extreme, which is this green line. And that would have been over a $2 move on 15 cents of risk. On 1,000 shares, that's a $2,000 trade. And you're only risking $100. In this case, I'm sorry, $150. This is Akamai on a 60-minute. People, traders always ask me, can I swing trade it? Well, you can. This is a multi-day trade that eventually nets you $1.05. And this is a trade on Garmin, a 5-minute. And I didn't even scale how much you make on that trade. This is NVIDIA. You make $1.08 on 10 cents. 1,000 shares, it's $1,000 on a risk of 100. Now, if you want to trade the market, open, or you want to trade gaps, there's a lot of information out there on how to do it, and I'm being honest with you, 99% of it is wrong, but I'm going to show you why it's wrong. Just hang on 1 second here. And that is, what takes place on a gap pre-market is pretty much irrelevant. And I'm going to show you that on actually a live trade today on Chipotle. The pre-market, a gap is created by the small traders like us. The institutional traders are not involved. So their take on how the market is going to move, once the institutional traders bring their money to bear on this particular stock, and this is Best Buy, is unknown. So you can't assess the quality of a gap. You can't make any assessment of gap trading pre-market because it's made on light volume and it's made with the amateur trader. And I'll just put amateur in quotes because they are us, because we don't trade, we don't put millions of dollars into a trade. The only way, now this Best Buy here is gapping down into the open. But once the institutional traders step in, they create those 16 metric alignment of the cash metrics to the upside, and Best Buy gaps up and runs. So you have to wait until the market opens. If the cash metrics align, take the trade in the direction that they tell you to take. You can't make any assessment pre-market. And you're often taught to assess a gap, make some kind of assignment of the gap pre-market, and it's impossible to do. I'm just going to skip that one too. Now here is Consolidation Entry. I believe, no, this may be the Canadian National Railway. This is an options trade I took a while back. I took it off of a chart just like this. It made $1.10. It's only a $15.90 stock, and it was a market open, a gap up, and a run based on the cash metrics, which stayed green for a long time on this trade. I'm going to skip Facebook. Here's the NASDAQ. Now, if you want to trade the NASDAQ futures, don't you want to trade it in the same direction as the NASDAQ cash? And this is the only software that applies cash internals to the trading of the correlative futures market. So if you want to trade the NQ futures short, the highest probability time to take a short trade is when the NASDAQ cash is aligned to the downside with these internals. You can't look at the absolute direction because the correlation is a little weak, but the internals have a tremendously powerful correlation. Same thing with the E-mini. Here's an E-mini futures trade when the S&P 500 cash metrics align to the upside. Here's a market open trade on the E-mini, 7.25 points, because you're trading in the same direction as the cash markets with an alignment of these metrics. Now I'm going to just quickly go over the actual entries that the system generates. Now, part of the offer today is going to be our auto trader, and this is what the auto trader looks for. The first is a strategy entry. The strategy entry. Now, remember, I really want to make it clear that this works on any instrument, on any time frame. Now, this strategy entry is a multi-time frame. It does a multi-time frame assessment. It looks at market structure and it looks at price action. So it's a smart entry. It doesn't look at an oscillator crossover, a MACD crossover, or any indicator confluence. It does a multi-time frame assessment of market structure and price action, and it really is a powerful entry. And I pay very close attention to these when they signal on our chart. And here's a short strategy entry. You see the 50s down and the 15s down for the strategy to fire short. And here's a short, and here's a long. Now here's the 15 cross 50, and a trade to the downside off the strategy signal. The auto trader would take that trade. Here's a long trade based on a multi-time frame assessment of price action, market structure, and trend. The auto trader would take that trade long, and so would we. Now, we don't have any of the other variables here, but just based on what we see, we would take these trades. Here's our ABC entry. We watch and the auto trader watches. And the ABC is the only entry that we have that does a single time frame analysis. But there's only one time we're going to trade it. And that's when we have the multi-time frame alignment, order flow and momentum aligned in our direction, money flow coming out of crude. So everything is moving in our direction. Now, any two candles aligned in the same direction, same color, create an A. That's a trend. For price action traders, we're looking for traders calling a bottom. This is a counter trend direction. And God knows why they decided that this is as far as crude is going to go. And then the software creates the C. It's a flashing C. You get an audible alert when the B closes, and I've elected to color this counter trend candle magenta, so it pops into my face, and then I look for the C to engulf. The C doesn't engulf, the whole assembly disappears because the ABC just didn't mature. But the C is going to flash. Put your trade in one tick below the close of the candle for the short trade. It gets pushed down by two forces. One, the addition of new short traders or new short money coming in, because this is in the direction of institutional money, and also you're stopping out all the traders in this counter trend candle. Here's another example. The B candle is the counter trend candle. You run it over with an engulfer, and down you go. Another example, 36 ticks and 36 ticks. This could be 36 pips. 36 pips, doesn't make any difference. It's the same principle. Could be 36 cents, doesn't matter. Now the consolidation entry is a real powerful one. Now consolidation is a period when volatility drops and the power of the bulls equals the power of the bears. We call a break of consolidation, I only have 5 minutes, by looking at a multi-time frame assessment of trend. And that's going to call a break of consolidation on your trading chart really accurately. If you got in on this up triangle, which is a consolidation trade out, which is a trade out of consolidation, you took some heat. There was a second one that occurred. The auto trader would have taken either one. We would have taken either one, and we would have gotten a nice move to the upside. You can see these consolidation channels here created by the software, but no signal, because the higher time frames didn't align and didn't comport with all the rules that we need in order to give you a trade out of consolidation to the upside. It's another consolidation trade to the upside. Two more, one to the upside, one to the, and you see we're always trading the direction of the trend. 50 and 15 up, 50 and 15 down. Now, these are just other trades. This is Wynn Resorts, trading in the direction of everything that I just discussed. We already looked at Facebook. Let me just go through these really quickly, because I want to be able to go over to the live charts now. There's a Forex. There's the Aussie dollar, 43 pips. That's a $655 trade. Looking at the same analysis that we look at on stocks and futures. Here's a 52 pip trade, same analysis, $610. Here's Netflix, Tesla, Apple. So let me just, these are two quick testimonials I'll read, then I'll go over the live thing. I've got 3 minutes, so I think I'm going to make it. Now, a lot of people throw up testimonials, and you don't know whether they're true or not, but I put up two from Top Step Trader. Top Step Trader's performance, the traders in Top Step are public, and they can't really say anything that's not true. And Jersey Tony's been with us 2.5 years and just talks about how our trading system has consistently made him money. And Jersey Tony's been in our room for 2.5 years. And D Moore, Trader D, is right here, DMOER. He won the $50,000 combine on Top Step in 2016, the 2016 games. He made more money than anybody else in the $50,000 combine. And D went 21 straight days without a loss. And his first paycheck, which came real quickly from Top Step, he made $3,000, which is amazing. He trades a small portfolio, very small amount of money, and 95% of traders are losing, and D is making a lot of good money. So let me just go over really quickly. I'm going to click this out. Now, I want to have time to come over and show you our offer, but here's our charts today. Now, I'm going to bring them down a little bit more. Now, today we made $510, and we only made it on 2 trades on 2 markets. And I'll show you the 2 trades. We made one of them on the NQ. I'll show it to you right here. Now, right here is this X is an auto trader trade, and we would have taken the trade. And that's a terrific trade right here. For 6 3/4 points on the NQ. But I'll show you. Here's our trade on the NQ right here. We entered here. If you'll notice, it's a strategy entry. We've got the slow cash line green, not the fast. We've got all the correlative markets green, telling us that there is a sector rotation of money, order flow and momentum green, and up we went for 5 points on the NQ. That made $620. I'm sorry, it made $230. And then we took a trade on, I think it was crude. Let me find it. I mean, we quit right there, right here was the entry. It was a strategy entry. See the background bias is pink. We went down 11 ticks. Nope, this wasn't it. It was here. It was this C candle entry. Again, we went 13 ticks, and we wound up making on those two trades $510. And all we're looking to do is trade in the direction of the multi-time frame trend. And now there were lots of better, it turns out there were lots of good trades on crude. I just wanted to stop. That was a terrific trade on crude right there, which while I was yakking away, recapping our day, a lot of traders in the room took for another 16 ticks, and that's just under a $300 trade. So they clocked out at 800. System generated entry, strategy, order flow momentum, and money flow, just shy of the multi-time frame alignment. One candle shy. It's still a great trade. Now let me just go back and show you our, let me just go back and I'll show you the offer that we're going to make. Let me just scroll down really quick. I'm running 1 minute over, and I'm not going to run anymore. I don't have time for questions, and I'm really sorry. If you have questions, please call us. But there's no way I could get all this information in, and I don't want to run over. Now, here's the offer we're going to make. Now, we have our own trade execution platform, which I'm not going to talk about. It gets you in really with less slippage and much greater precision. It's included 3 months in the live trading room with me. I'm going to teach you our methodology. We make money in the trading room almost every single day. I'm going to put you into trading school, along with, we have a lot of people, we have 125 people in the trading room, and I don't know exactly how many people we have in trading school, but it's a lot. It's a 10-week live course. Get access to our video tutorial library. We have 400 videos, and the first 5 orders will also get the automated trader. Now, the day before yesterday, you had 7 trades and 7 wins. Now, I don't have time to show you the equity curve, but it's up over $25,000 so far this year, and it only trades 2 contracts or 3 or 4, and it automatically manages the whole trade based on volatility. It sets your stops and sets your targets. It's a really smart system. Now, here's our number. We're at Right Line Trading, info@rightlinetrading.com, 786-713-5276. 786-713-5276. And the order, I'm sorry, it's $3,000 or 2 payments of $1,550 a month apart. That's our system. Hopefully you'll make that back in the first month easily. We look to make $1,000 a month, I'm sorry, $1,000 a week in the trading room, or $4,000 a month on a very tiny account. All right, everyone, thank you so much for giving me your time. I really appreciate it. I hope to see you in the trading room. Either way, I wish you the best of luck, and thank everybody for having me. Take care and so long. Thank you much.